Hey, it's Richard with Matthews Wealth Management. We're going to be going over the August 2022 asset class performance. You can't say I'm not an optimist. I've got the green marker. Whoops. Moving along here, we've got our U.S. equity performance. If you're familiar with our process here, this makes sense, but for the new people, large cap, there's our big companies, mid cap, small caps, getting from big to small. Value business, core is kind of a mix between value and growth-oriented businesses. So if you notice here, the value side lost the least. That might be the best way to look at that. Growth side kind of fell off of a cliff. Now I'm doing this video actually mid-September, September 19th, so a little past mid actually. And we've had another correction, told you so, that makes these numbers so much worse. So September is going to be red, not green, sorry. But yeah, if you look though, from large to small here, it's kind of opposite. It's inverted from what we would expect. We'd see the biggest loss on the small side in a worsening economy, as we definitely have. Technical definition of recession, good Lord, people. But yeah, that is kind of a strange piece of it, and it just illustrates again the bubble of large cap growth and tech stocks, and when money's printed, that tends to be where it flows to the large cap growth, and you know, that's why you see crypto mirroring that as far as correlations are concerned. Go across the globe now. International down about 5%, almost 5%. But my sole green number is emerging markets. And back in June on our reallocation, was a little bit frustrated at myself for not selling more emerging markets. Don't get me wrong, they're down. They're very down for the year especially. But that was kind of cool to see. And where this is coming from is a lot of currency issues where the ECB raised their rate by 75 basis points, and now there's this competition between Fed and ECB, and clients, y'all know my take on this and how that's going to affect the euro in the long run. But yeah, you can see the emerging markets starting to get a little bit of breathing room on the squeeze from our currencies, the idiots' currencies. But let's jump into bonds. Everything's red. Short terms have lost the least, as they should. I mean, there's nothing surprising here. Long term's getting hammered the most. If you recall, we're basically out of those. As much as I can justify being out of those as far as allocations are concerned. Tips falling off, that's a little frustrating. High yield's not bad, down 2.3, especially with what we'll see in the M2 and the balance sheet. The Fed's selling a lot of high yield. They're selling a lot of treasuries in all of them, but only down 2.3. I would expect that to accelerate on the downside, especially knowing what I know in September. Yeah, so bonds are down, stocks are down, positive correlation, and everybody's surprised for some reason. Oil, this one's the biggest frustration from our standpoint because we're very long commodities. We have a lot of overexposure to commodities, specifically oil and gas, equipment, services. To be down 8%, I mean, it's a buying opportunity. We've got a ton of cash on the sidelines. Our timing for doing a reallocation and dollar cost averaging a lot of cash in, that's actually a pretty decent area right now. There's no reason oil is as low as it is except this strategic release, which ends at the end of September, as a matter of fact. Then we'll get back to what oil should be. But in the meantime, we've got a big dip there, which makes our numbers look worse, obviously. But gold, go figure. A lot of JP people went to jail recently for manipulating precious metals market. So maybe more people will be arrested, but we'll see. Real estate, starting its bigger trend down, 6% in a month. Commercial real estate, residential real estate, office real estate. It's a strange time for real estate. I had somebody at a party the other day ask me what I think of real estate, and man, it really depends. It depends on your geography. You know, we've still got the migration going on. Once layoffs occur, we'll have another wave of migration, I believe. Zoom-based businesses was one big push that we went during the pandemic, not to mention the lockdowns and all the forced vaccines and everything. People wanted to relocate and make that change in life, and I think we'll see it come again. But if you're in Detroit, not looking good. If you're in Greenville, your prices are only going up at this point. So is that good? I don't know. Depends culturally. But let's look at all of the measurements that we use. So the NASDAQ, that's going to be very reflective of tech and large cap growth. So year to date, they're down over a quarter of their holdings, right? So Warren Buffett's first rule of investing, first way to make money is don't lose money. Yeah, all you bubble chasers, how you feeling now? That's rough. Good luck digging out of that one. S&P is a better mix across all of the different asset classes in U.S. equities, down 16%. Usually you would see a moderate portfolio that would be like a 50-50 stock and bond give maybe an 8% loss, but it's down 14 just because people didn't think about interest rate risk on long duration. So it's right in the same ballpark as full on risk. Bonds are not safe, guys. And so here we are, we've preserved an extra like 3% above what moderate has lost. That's not thrilling. Clients aren't happy about it. In professional money management, we can't avoid loss, we can minimize loss. That's literally how we're judged, and we can make more gains. You make more, you lose less. That's my job. That's what I do. So by the numbers, decent. We're not angry. We're not. A lot of it's this oil. That's really driving me crazy because I could then show probably a good 4.5% gap there. But it is what it is, and we'll see how these numbers look next month. If you got any questions, if you have any ideas of what to cover, I've dropped the rant video. I've got a new channel that came out. I'm a part of a group that's pushing in the upstate for discussion about our local economy, and that's kind of my outlet at this point in more of a dialogue format. So be on the lookout for that. But yeah, it's just easier to not have to spend 4 hours filming all of these videos. We've got the new building. I've got to do a video for that, bring that out there so everybody can see. Yeah, it's just crazy busy right now. And about to jump into client meetings. We're looking at another reallocation coming up before the end of the year, timing that with election and how that's going to look. So just a lot going on. But if there's something you want to see, something that you want to cover, something that's not making sense in the way that I'm doing this, my whole point is to be transparent and educate. So if something's not coming through, comments or phone calls or whatever. But hope this is helpful. I know it's not to lose money, but there are ways to mitigate loss, and that's what we do at Matthews Wealth Management. So if you have questions, want to talk to us about managing money, pick up the phone, call us. It's pretty simple. But other than that, that's August. We'll see you in September.